Welcome everybody. Emron, can you confirm whether you can hear me? All right, welcome everyone to part 3 of the BDO transfer pricing webinar series. Your moderator today, my name is James Mwagawa. I'm a senior tax advisor with BDO at the Uganda office. Today we shall be looking at managing transfer pricing risks. This forms part of the key aspects in transfer pricing. It could be a complex issue as blocked income, or it could be a small issue as having the Revenue Authority asking for information. Any of these, whether complex or simple, it's always important to know how to manage the particular risk that you're facing and the key aspects that you need to look at. Our panelists today comprise of distinguished members in the tax practice profession within the East African region. We have Mr. Juma Buli, who's a senior manager at BDO in Uganda. We have Zioka Mwindi, who's also a senior manager at BDO in Kenya, and Steve Okoth, who is a tax director in Kenya. These form eminent tax practitioners in the country, I mean in the region, and they shall be taking us through the presentations. The agenda for today we'll have opening remarks from John Jet Tusabe, who's the tax director in Uganda. And then we shall have presentations from the three presenters, that is Juma first, and then followed by Zioka, and lastly Steve, who shall also take us through how BDO can support us in this area. With that, I'll open the floor for John Jet. I don't know if he has joined us already. Yes, John, you can take us through the opening remarks. John, are you with us? John, I can't hear you. Are you with us?
James, I can hear you. Can you hear me?
Yes, we can hear you now.
Perfect. Thank you. Greetings, everyone, and thank you for making it to this webinar, especially after lunch, when I hope you are not exhausted from the lunch, for those who are not fasting. And those who are fasting, thank you for making it, given that you might, transfer pricing is a very technical area which requires engaging your brain quite a lot. But the good news is that the experts we have on this webinar are going to make it easier for you to comprehend, and at the end of the day, you are able to make sense out of it to mitigate the risks. Transfer pricing, as you might be aware, mainly applies to when you have transaction with related parties, and as businesses grow across the region, or with the new Africa Free Trade Area Agreement,
John, we lost you there for a minute. Are you still there?
Side of government is quite high. The needs are very high. The infrastructure funding gaps. Where is the coming from?
John, you may need to adjust the network connection. Here you may
gaps. Although
John, we have lost you.
Areas need funding, and as an app is transfer pricing abilities that we have seen in some cases where the hear me?
All right. So sorry about that. I think we lost.
John, we cannot hear you.
Yeah.
Okay.
Okay, Juma, let's move to Nzioka first. Then by that time, we move to Nzioka for the Kenyan part. Then by that time, John shall have resolved the connectivity on his part.
Thank you, Steve. I think I'm back. Can you hear me?
My apologies, everyone. We seem to have had a general network issue at the Uganda office, but I'm back. Steve had suggested we start with Zioka from Kenya, but let me first ask Juma.
Recorded.
But I think we can proceed with Juma because he's here. So Juma, please, you can proceed with your presentation. Once again, apologies for this network issue. As Juma is trying to address that issue, the attendees are advised, if in case you have any questions, you can send them through the Q&A icon. The presenters will be available to address them as they come in.
Okay, thank you. Please confirm that you can hear me, Steve and James.
I can now hear you.
Okay. Once again, we are sorry for that mishap. I was saying that the theme for this webinar is managing transfer pricing risks or managing transfer pricing controversy. And my focus is going to be transfer pricing disclosures or compliance requirements in the region. So you may ask yourself why I'm talking about, compliance. In order to manage risk, whether it is any kind of tax, what is very important is to comply. In fact, when you are complying, you are managing risk. So it is very important for you to comply with the transfer pricing rules or regulations. That way, you are actually already managing risk. Because once you comply in the best way you can, then you minimize the chances of the revenue authority coming at your door knocking. So my presentation is going to be focused on compliance. It's going to be quite high level because we had this session earlier. So mine's just going to be a recap of compliance requirements in the region, just to remind ourselves of what we discussed in the earlier presentations. Next slide. So I'll start with Uganda. Uganda, first, is not a member of the OECD. The OECD is short for Organization for Economic Cooperation and Development. It is an organization that it is a tax policy think tank and it has helped to shape tax legislation in many countries. If you check the statutes, tax statutes of various countries around the world, you'll find that a number of sections are actually influenced by research that has been done by the OECD. So there are so many organized countries across the world that are members. Uganda is not a member, but we largely, our TP rules follow the OECD guidelines. So that's how they were formatted. But in cases where our TP rules conflict with those of the OECD, then ours prevail. Then the other issue I wanted to talk about, our TP rules cover both local and cross-border transactions. As you know, in many countries, transfer pricing only covers cross-border transactions, and where there are some local transactions, tips, many countries, the TP rules don't cover. But in the case of Uganda, and indeed many East African countries, TP rules cover both local and cross-border transactions. Now, for local, it means if you have a related party, if you have a related party within Uganda, two related parties, and they're transacting, that kind of transaction is covered under the TP rules of Uganda. It is also called domestic transfer pricing in languages. So for Uganda, those it covers both local and international. The only difference when it comes to the local transactions, then there are some thresholds. So if the local the local TP only comes in if the related party transactions in aggregate equal or are in excess of UGX 500 million shillings, which is 130,000 USD. So which means if you have some local transactions and in aggregate they are less than that, then the local TP rules don't capture such a transaction. So you're not required to have a TP. But in case of cross-border transactions, there are no thresholds. So whatever amount, it is covered under the TP rules. Of what is happening across the world, which is called BEPS, which is base erosion and profit shifting, still which is spearheaded by the OECD. It is a program which helps in managing or in combating aggressive tax planning. So it came up with that what we call BEPS Action Point 13, which requires which has certain requirements. It requires that you must have a local file, a master file, and then what we call a country by country report. So in the case of Uganda, that has not yet been adopted. So we only have a requirement to have a local file, which is the equivalent of a local TP file, which will document the transactions with related parties. So we have not yet adopted BEPS Action Point 13, which I just explained. Then the other issue, branches and foreign companies are required to comply with TP rules. Legally, a branch and its headquarter entity are one and the same legally. But when it comes to transfer pricing, there is an exception. Those two entities are considered separate, which means that if a branch is transacting with its headquarter entity, that transaction, although legally it is with the same entity, but for transfer pricing purposes, those two persons are considered different and they are required to comply with the transfer pricing regulations, which means that if there is any transactions between them, it has to be documented in a transfer pricing report. I already talked about BEPS Action Point 13 implementation, and I said that we have not yet adopted that one. So there are no requirements in Uganda to file TP documents, whether in a return or any kind of information, or you submit it to the Revenue Authority. All you have to do is to ensure that you have it in place at the time of lodging the income tax return. So you must have it, which means that you only submit it to the Revenue Authority on request. So when it comes to updating the TP reports, no TP reports, you can't have it in place and you don't update it regularly. So there is no requirement to update it every year because we know benchmarking results become obsolete. So the requirement is you don't have to do it every year. If you can do it once a year, that is considered
Chuma, some members can't seem to be hearing you.
Nzioka is okay. So let me just present on this part of Kenya, and then we move to the next part. So as you can hear me well?
Yes, Steve, we can hear you.
Okay. So the landscape in Kenya for transfer pricing, the law which is in place for compliance with transfer pricing requirements, it's largely consistent with the global practice. There are a few differences or just additions, but largely Kenyan transfer pricing landscape, transfer pricing regime is completely consistent with the global practice, and the global practice is enshrined in the OECD transfer pricing guidelines, which everyone applies. Also, the Kenyan courts, the Kenyan High Court, Court of Appeal, in the past, the Tax Appeals Tribunal, these judicial bodies have proclaimed many times in many cases that where the Kenyan Income Tax Act and the Kenyan Income Tax Transfer Pricing rules are not very precise, then reliance is to be placed on the OECD material. So this is the OECD Model Tax Convention, OECD Transfer Pricing Guidelines, OECD Guidelines on Attribution of Income to Permanent Establishments. These are branches of foreign companies. Or the OECD material form out of interpretation of the judicial process in Kenya. They form part of the body of laws in Kenya as far as transfer pricing and international tax is concerned. So that really brings us into consistency with global practice and consistency with the OECD or guidelines. So we've had a Section 18 of the Income Tax Act of Kenya, which outlines that transactions between resident persons, largely this will be companies, and their non-resident related parties, or those transactions need to be consistent with the arm's length principle, in that they should be priced as if the local entity or the entity which is undertaking business here was dealing with a third party and related, and they were pricing transactions, or as if they are not related, they have no relations, just as per the market practice at the particular time. So this really is the main law. Section 18 has been there for long, even before the transfer pricing rules came into being. Or that section has always been there. Transfer pricing rules were brought in to fine-tune the requirements of fulfillment of that arm's length principle. And then later on, the OECD materials have now been adopted as part of the laws of Kenya. So this is really the body of law as far as transfer pricing in Kenya is concerned. That's really the A to Z of it, or nothing much out there. But we also have to note that this also brings into process that as the OECD mechanism is being updated over the years, or the BEPS project and the changes that it has had onto the OECD guidelines, the ongoing international debate for transparency on transactions and investments and financial instruments or that are held by persons in all the countries that are signatories to it, the common reporting standards, the master file and local file requirements, the country-by-country reporting requirements. These ones are international developments that are taking place, and they are taking place also has to be, the Kenyan system is aligned with that. And for that reason, we are finding ourselves in a situation where the Income Tax Act is continuously being updated. There were changes that came in last year, the beginning of last year, and then there are changes that came in last year and are now effective from 1st of January 2023. And so we are finding that Kenya really, we even have the country by country reporting requirements for companies which form part of groups which have at least a turnover of 95 billion Kenya shillings. And these are now becoming part of practice. So in a nutshell, I can say that what happens globally at the OECD and at the international debate on international tax and treatment of cross-border transactions, Kenya is showing fidelity and faith in the international process fully, and we are domesticating those requirements into our own law. We even have the requirements for companies to demonstrate their ultimate beneficial owners. These are all part of the international process, and Kenya is showing complete adoption of the same.
So I think I can continue.
Thank you so much, Steve, for coming in. Let's have Juma continue with the presentation.
Thank you, Steve, for coming in for me there. So I think we're done with Kenya. I'll just proceed with Tanzania. Tanzania as well is not a member of the OECD, but the guidelines that they adopted, they follow actually both OECD and the UN transfer pricing guidelines. The arm's length principle requirement is contained in section 33 of the Income Tax Act of Tanzania, and the guidelines, the TP guidelines, came into force in February 2014, but they were published in May 2014. These same guidelines were updated in April 2018. So, like I said, they're in line with both OECD and the UN. Like I said, for Kenya and Uganda, the TP guidelines for Tanzania also cover both local and cross-border transactions. So it is very important to take note of that. When it comes to BEPS Action Point 13 implementation, Tanzania has not yet adopted it. So that means that companies only required to maintain a local file, and then the master file is not a requirement, as well as the country by country report. When it comes to thresholds, there are no thresholds, which means that all transactions have to be documented. All transactions that fall into the ambit of transfer pricing have to be documented in a transfer pricing report. Like the same issue with Uganda, branches are required to have their own TP documentation, which means that if a branch is transacting with its headquarter entity, it is required to document that transaction in a TP report. When it comes to filing TP documentation, that is only required for taxpayers with an aggregate value of related party transactions of 10 billion Tanzania shillings, which equates to about 4.2 million US dollars. So if you fall into that category, that means you have to do some filing with the which is the Tanzania Revenue Authority. Anything below that, no requirement to file, but you must have it in place in case the Revenue Authority requests for it. Then for Tanzania, they need to disclose related party transactions, both within and outside Tanzania, in their returns. So if you are filing a return in Tanzania, you also have to disclose your related party transactions. You saw in the case of Uganda, there is no such requirement. The return doesn't mention that, but you're only required to have a document in place. And when the Revenue Authority asks for it, then that is when you give them the information. The RTP rules are a bit strict because they require that the benchmarking has to be updated every year. And that, of course, pushes the cost and the burden of TP. If you fail to comply with the rules, there are some penalties which are prescribed under the guidelines. And in this case, it is about USD $22,000. When it comes to disclosure of related party transactions in the financial statements, that I don't want to go deep into that. That is completely an IFRS requirement, and any country that has adopted IFRS as the financial reporting framework, they are required to disclose related party transactions under IS 24, but I'll not go into that. Let me go to the next slide. I'll go to Rwanda. So Rwanda is also not a member of the OECD, but the guidelines they adopted are in line with the OECD guidelines. Under Article 13 of the Rwanda Income Tax Act, there is a requirement to comply with the arm's length principle. The ALP you see there means arm's length principle. And then the TP guidelines were issued recently in December 2014. The TP rules cover both local and border transactions. Branches, like in the case of the other East African countries, are required to comply with the TP rules, which means transactions between branches and the headquarter entities, they are required to document those transactions. I'm going to be a little faster because of time. Transfer pricing documentation must be in place prior to filing the return, which means you don't have to submit the TP report to the Revenue Authority. In Rwanda, still the BEPS Action Point 13 has not been adopted fully, but what they have said in Rwanda is that if the parent is required to do a country-by-country report, where that's where the parent is domiciled, which means if where the parent is domiciled, they have fully adopted BEPS Action Point 13, then Rwanda says you submit the country-by-country report for Rwanda. Related party transactions. So for BEPS, master file is not a requirement, but the country-by-country report is required. Of course, the local file will be required. TP documentation has to be updated annually. That pushes the cost of TP compliance. And in case the Revenue Authority requests for a TP report, you must provide it within 7 days. Now that is a very short time, which means you have to ensure that you comply with regulations. I said that a new benchmarking study is required every year. That is quite a harsh requirement because we know that the OECD guidelines, like I mentioned earlier, they state that you only have to update every 3 years. But in the case of Rwanda, they're strict, and they're saying that you must update your benchmarking results every year. I'll go to the next, South Sudan, quite a new member of the EAC. and one of the youngest countries in the world. So you would expect that their transfer pricing regulations are not that developed. So South Sudan is not a member of the OECD, but they broadly follow the OECD guidelines. They do not have specific transfer pricing regulations, but within the Taxation Act of 2009, there is a section that requires that related party transactions must be in line with the arm's length principle. For South Sudan, the TP rules only cover cross-border transactions, which means any local transactions with related parties are not covered by the TP rules. And local branches are also required to have their own TP documentation. There are no timelines for submission of TP reports. It should only be available on request. The Revenue Authority has power to carry out transfer pricing adjustments, and that this is the same case with all other countries in the region. I'll go to the last, that is Ethiopia. Ethiopia is also not a member of the OECD. The TP guidelines or the requirements to comply with the arm's length principle is contained within Article 79 of the Income Tax Act of Ethiopia. And the TP regulations were issued and they became effective October 12, 2015. That's quite recent as well. The taxpayers are required to have TP documentation at the time of filing the return. So there is no requirement to file the TP reports with the Revenue Authority. There is a threshold when it comes to transfer pricing in Ethiopia. So taxpayers involved in international transactions, they are only required to document transactions if the amounts involved exceed 500,000 Ethiopian currency. That is a very small threshold, which means that almost all transactions are covered. Because when you look at 500,000 Ethiopian currency, that equates to about 9,000 USD. So that is it for transfer pricing compliance on a high level for in the East African region. We've also considered Ethiopia in our submission. I beg to end here, and over to you, Mr. Moderator. Thank you very much.
Thank you so much, Juma. Juma, if you could. Yes, thank you so much, Juma, for your presentation. Thank you so much, Juma, for your presentation. I think what we can pick out from Juma's presentation is that there are a lot of similarities between the region in terms of transfer pricing compliance, but still there are also very significant differences. For instance, Rwanda's benchmarking requirements, the differences in thresholds, and also in terms of the scope of covered transactions. So it's very important to have a clear grounding in knowledge on what is required in each region for you to be able to comply. Juma, I'll kindly request you to address the questions that have been raised by some of the attendees in the Q&A. Some of them have been touched on in your presentation, but it would still be important to give a direct answer. I can see Dina is asking what are the local requirements which represent a departure from the OECD transfer pricing guidelines. We have Huntington asking about the documents needed under the practice note of 2012. We also have Dina again asking about Kenya. And with Dina's thinking is that in Kenya, both a local file and a master file are required. So Juma, kindly assist in answering those questions. We shall go directly to our next presenter, Zioka from Kenya. She's a senior manager in Kenya. Zioka will be handling an overview of transfer pricing risks. Over to you, Zioka.
Thank you, James, and thank you, Juma, for the good presentation. So at the moment, we've already now looked at what is required from a compliance point of view for all the East African countries. So now we'll jump in and see if you don't undertake proper transfer pricing compliance, then what are the risks that you are looking at? And with these risks, what are the resultant impact? And lastly, we will look at how to what really indicates that there is a risk from a transfer pricing perspective. So my training will basically focus on looking at transfer pricing, just reminding ourselves what is it, and we also look at what is known as transfer mispricing, an interesting concept, by the way. Then we'll go ahead and we'll look at what exactly does transfer mispricing entail, and defining what transfer pricing risks. Then lastly, we'll look at all what are the risk indicators for transfer pricing. Now, what I would want to point out at this stage is that, when we look at transfer pricing risk indicators, we are looking at what is actually happening within the company or within the financials of the company that will indicate that there is a problem from a transfer pricing perspective. Then later on, now Steve will pick up the presentation and he'll look at what happens now when the revenue authority comes in and starts takes a transfer pricing audit, and what risks are observed, what are the triggers for such an audit, and how to manage such an audit. So with that brief introduction, now I'll move in and we start with the presentation. So let's look at what is transfer pricing. All of us here, this is not our first time interacting with transfer pricing, and if it is, welcome. But basically, transfer pricing is the interaction between related parties, and we're looking at transactions that occur between related resident parties and non-resident parties in specific jurisdictions, and in other jurisdictions, they go ahead and
Zioka, there is something. Zioka, you may need to adjust your network connection.
The local jurisdiction is relationship. Now, because of this relationship, pricing can be yes. Am I audible? I'm still. It's okay. Just need to stop using that. Then. So I'm back. Am I audible?
Yes, we can hear you now. Thank you.
Juma, you guys can hear me?
Yes, we can hear you. Zioka, can you hear us? Zioka, are you still with us?
I'm with you. Can you hear me, James?
Yes, we can hear you now. Nzioka, we can hear you. Can
Guys,
proceed.
guys, you can hear Nzioka well, eh?
Yes, we can hear him. You can proceed.
All right. Okay. So, okay. Thanks. So when we are looking at, I was just defining transfer pricing, and I was basically saying that this is a pricing and study of transactions between two related parties or two associated parties. In Kenya and other jurisdictions, it's only restricted between a Kenyan resident entity and its related party outside Kenya. Whereas in other jurisdictions, it's actually there, like now Uganda, it also includes the entities that are related but are in the same, are just within Uganda. So it's broad, but basically transfer pricing is a study of transactions between related or associated parties. Now, when we look at transfer pricing, it creates an issue because when two related parties are transacting, they can fix prices, there can be unfairness, or you can want to push on one entity and not have the other suffer some financial kind of cost. And that's why transfer pricing compliance matters are very key. And that's why transfer pricing is key even to the Revenue Authority to ensure that we are able to tax correctly and to tax appropriately. And therefore hence why we say that there's TP methodology, and in observing this TP methodology, pricing of transactions between related parties should be done as though the parties were dealing with each other at arm's length, whereby the transfer price applied upon observance of transfer pricing laws and regulations. And we define that transfer price as being the value or price at which transactions take place amongst related parties. And in this example that I had put in the presentation is where a subsidiary of a company can supply goods or services to its holding company. And that price is what is, and the price at which the subsidiary entity sells the goods or services to its parent company is what we refer to as that transfer price. Moving on, we'll now look at the two aspects of transfer pricing from an arm's length perspective, and look at what is the arm's length principle and look at what ideally is arm's length pricing. James, you can move to the next slide. So arm's length principle provides that amounts charged by one related party to another for a given transaction must be the same as if the parties were not related. Basically, we're looking at pricing as if there were third parties. And in this case, when you don't observe the arm's length principle and apply the arm's length pricing or the transfer price, then we go to what is known as transfer mispricing, and that is non-compliance with transfer pricing rules and regulations. So basically, now we are asking ourselves, what is transfer mispricing? And transfer mispricing is the application of
I think we lost our people from Kenya. Emron, you could kindly assist to get in touch with our people from Kenya, and so that they can join in. As they try to join in, I'll kindly request the other panelists to get into the Q&A and address some of the questions. There are currently 6 outstanding questions, so you may need to go there and answer them. Steve is back. Can you hear us now?
Yes, I can hear you very well. Yes, I can hear you very well.
Okay, Nzioka, it may be,
yes, it
may be necessary. Yes, you can proceed, but it may be necessary to remove your video for network connectivity to work properly.
All right. Yeah, I've removed. So yes, so basically when we look at transfer mispricing, we can define it as the application of a transfer price on transactions between two related parties that that do not observe the arm's length principle. Basically, we are saying this is a price that if two third parties were to deal with, then they would not agree to continue with business. For example, if I'm buying as BDO, I engage BDO Uganda, then I should be able to price my transaction such that even if I was to engage another audit firm in Uganda, that the pricing would still be within that same range. Anything other than that now leads to transfer mispricing. And consequently, when we have transfer mispricing, it results to the erosion of tax bases and enhances profit shifting in countries with high taxes to those with low taxes, thus enabling avoidance and evasion. This is very wrong because if income has been accrued or derived in a particular country, then that country has the taxing rights to that particular income. And in shifting all of these profits outside from that country without the fair taxation regime applying, then we have a problem. And with that problem now, the Revenue Authority may come in, and when they do look at it, you may end up incurring taxes and penalties and interest because of non-compliance with those tax regulations, rules and regulations in that country. Now, the issue of transfer mispricing is not only relevant in developing nations, it's also a problem for developed nations. I think publicly, what has come out is that a lot of these huge organizations in the US, like the Amazons and the Googles, do not really pay too much tax in the US, and the US has been having that issue because of transfer pricing and also offering of digital services, etc., etc. So this is not just an issue for East Africa, Kenya, or East Africa, or Africa, or even any other developing part of the world, but it's also an issue for those other developed nations where there's aggressive structuring. And moving forward now, the question we ask ourselves is transfer mispricing an issue that is unintentional, like, it happens because you didn't particularly know so, or does it happen and basically you are the entity was aware, or the group was aware, so was it by design? Now, based on experience, I can say that it happens both ways, and it happens in the sense that you have a country, like an entity in one jurisdiction that may not be very well aware about the transfer pricing laws and regulations. So they haven't just observed that, or they haven't had developed a transfer pricing policy. Then there's a situation where it's very deliberate, and this particular group is actually undertaking a transfer mispricing activity for purposes of avoiding and evading taxation. So based on experience, I can say for sure it is both ways. But ideally, that's why even as clients, you are here, because we need to make sure that we comply with transfer pricing laws and regulations here in East Africa, whichever country that you're operating in, and even globally. So with all these practitioners in tax, there shouldn't be really a reason as to why we are not compliant. In addition, the revenue authorities have also become quite aggressive in ensuring transfer pricing laws and regulations are observed, especially for those countries here in East Africa, like Uganda, Kenya, Tanzania, that have had, and Rwanda also, that have very robust revenue authorities, and they're also developing the practice there, and also developing the interest in ensuring that that is taxed in the right, like all the transfer pricing rules and regulations are observed. So based on, currently as we speak, all those revenue authorities are becoming quite aggressive in their implication of application of transfer pricing rules and regulations. So now we have looked at what is transfer pricing, the aspect and concept of transfer mispricing. Now we will look at what are transfer pricing risks. So when you have transfer mispricing, what are these risks? The transfer pricing risks can be defined as the existence of underlying liabilities arising due to lack of pricing of related party transactions at arm's length, or in short, just not lack of observance of transfer pricing rules and regulations. And as accurately captured in the slides, you'll see that this can occur where related party transactions are not governed through a transfer pricing policy, or even in the event that those transfer pricing policies exist, the appropriate methodology in formulating or developing that transfer pricing policy has not been undertaken. So you find that, yes, you have a transfer pricing policy, but the method used maybe is not the right one. And I can even give a practical example that I have dealt with just in the recent past, where a company was actually offering a sales service here in Kenya to its head office in France. And unfortunately, this particular company here in Kenya was computing, had a transfer pricing policy, and it basically characterized the service as a marketing service. So they would just apply a markup on all of their costs rather than apply a commission on the sales that have been undertaken in Kenya, the sales that they've generated in Kenya. Because when you're an agent, a sales agent, then your remuneration is commission. When you're offering a marketing service, then your remuneration is a service fee, and it's based on the cost that you've incurred and the pricing of your service, whereas that of a sales commission is normally as a percentage of the sales that have been undertaken. So there was a transfer pricing policy, however, it was wrong. And that's why we are looking at B as that's an example of how that can occur. We can move to the next slide. So when we look at transfer pricing risks, I can confirm to you that most of the or a very huge chunk of the assessments that we have dealt with, even as BDO, where the Kenya Revenue Authority has undertaken an audit, and specifically a TP audit, they come up with huge liabilities. The biggest liability in my entire career that I've ever seen was witnessed through a transfer pricing audit, and where those liabilities came to being, and basically the entity ended up folding because they could not continue the operations anymore. And these risks are huge. And even when you look at when a new entity from outside Kenya wants to invest in Kenya and decides to acquire another entity, then they come in and acquire this company that maybe had relations with its non-resident entities. And when we go in to do a tax DD, we find that there is a huge liability. So there might not be any huge legal liability or financial liability, but the tax liability, because you can't visibly see it, you have to undertake an audit process of your own, a due diligence exercise. You find that the liabilities are huge, and it even breaks the deal, where the investor may decide to start afresh and put in systems in place and not acquire that entity. Or like the previous example that I had given, where this entity, just has to fold up and pay up all these tax liabilities and can no longer continue with business. So when we are looking at these transfer pricing risks, what are the indicators? What do you see that you're like, yes, there might be a problem here? Just like dark clouds in the sky may indicate there's rainfall on its way, these are the indicators that reflect that there might be a transfer pricing risk, underlying transfer pricing risk. And I would want the attendees, both from our profession and even those in business, to take note of this, because this is what will indicate to you if maybe you might be having an issue. So the first one is the lack of an existing transfer pricing policy, whether it's a master file or local file, governing those related party transactions. That means that this particular entity has related party transactions. However, there's no transfer pricing policy in place to govern those related party transactions. This is a red flag. And as such, when we audit and we find that a company does not have a TP policy despite having related party transactions, we are we definitely can tell that there might be a problem from a transfer pricing perspective. Secondly, is the lack of supporting documentation. This is items such as legal agreements for services or loan agreements where there is debt that has been provided. Because when you combine the two issues where you don't have an agreement, you don't have a transfer pricing policy, then the real question is, then how did you reach this pricing for the related party transactions? And especially where a subsidiary or an entity in that country is fully reliant on a non-resident entity, then we do have problems. We may be having problems from a transfer pricing perspective. And that's a real red flag also. Number three, we look at out-of-range product pricing, where there's significant differences in pricing with respect to goods and services between related parties. And basically, when you go to the market and you see some certain products being sold, and they're being sold at an interestingly lower price than the market price, and these goods are being sourced from a related party out of the country, then this might be a good indication that there might be transfer pricing risks for this particular entity in the country. So that is an indication, because for you to justify why your certain goods that you've imported are lowly priced, whereas competitors or similar goods are being priced maybe at a higher rate, then there must be something wrong from a pricing perspective. So we need to find out exactly what is this, and find out whether it's arising from a transfer pricing risk, a transfer pricing problem. Now, when there are times, and I can give a good experience on this. Like, there was a point when the KRA went for a certain company, and they were like, yes, you've imported these items.
Nzioka, we've lost you there. Nzioka is still there.
Much lower than the rest of the. Now, when we did our investigation, hello, James.
Yes, we can hear you now. You can proceed.
All right, fantastic. So, like I was saying, with the third point, KRA basically asked this client, this taxpayer, why are you having your goods priced at a lower price, or rather you're importing them at a much lower price than the rest of the rest of the suppliers in the market? And we did a study. We talked to the client, interviewed, and eventually we found out the country of origin of those products. Basically, it was giving an incentive, and this was with respect to solar powered items, and there was an incentive in that country to go green. So they were paying lower taxes, and the raw materials didn't have tax. So eventually we were able to prove that this was not a transfer pricing issue, but basically this was a pricing, this was caused due to incentives. The low pricing was caused due to incentives provided in the country of origin. So those are some of the examples that I would give where, transfer pricing, can influence that particular cost of the transaction. Number 4, it's the inability to justify commercial substance of a transaction. And there are cases where, you find that a related party is paying for a service that ideally has not been performed or consumed. Example is when you incur management service fee and you pay to a related party and there's no service that is being performed at all. So this entity that you're paying money to for management fees basically does not have employees, does not have an office, does not have any form of activities going on. And that is unfair practice, and basically that's just a way of extracting profits or extracting funds from a particular company without ideally having before taxation of the profit. So I think that's a clear example, and we can go to the 5th point. So whenever there's compensation of intangibles or intellectual property, then there exists a transfer pricing risk, and you may need to ensure that the pricing of that particular transaction is actually at arm's length. For example, if you are paying a royalty or a license fee to a related party, is that justifiable? Is the pricing, is first and foremost the payment of that royalty or license fee justifiable? And if it is it at the right price? Is it at the arm's length pricing? So this is what we, is also another indicator of transfer pricing risks that may exist. Moving forward, we have profitability being also an indicator of transfer pricing risks. And this is when an entity with related party transactions that is not within the expected industry margins or norms. So if a company is not performing or a business is not performing as it is, and there exist related party transactions, the question to ask is, would these related party transactions be affecting the profitability of this particular company? Then as we move on, there's a record of consistency in being in a tax loss position. So I think that one is just self-explanatory. And when you look at it, when you're never making a profit, you are consistently in losses, both financial and tax, and specifically financial, you're consistently making a loss. And this company has a record of making a loss for more than 10 years. Then it is an indication that there is a problem. It is an indication that there's something not right, and we are not in business to keep on sinking money into a business and never making a profit. So if there are related party transactions between those two, with that particular entity that is having huge financial losses or constantly being in a loss position, then there might be a problem from a transfer pricing risk. Transfer pricing perspective, and it is important to look at such and make sure that basically if there's a loss, then transfer pricing is not one of the reasons why the company is in a constant loss position. And that goes hand in hand also with the inconsistency in tax remittances. So, most businesses are expected to at least grow periodically, and even when they're in a position of a loss position, maybe it can be indicated through some heavy investment or etc., such kind of issues. And if it is not, and the tax remittances are inconsistent, then the revenue authority may start questioning itself as to why is this company, if we draw a graph, and after drawing a graph, the graph reflects a heartbeat, up, down, up, down, up, down, then there's a problem in that particular company. And if there are related party transactions, that could be an indicator of where the problem is. So we'll move on to the next slide. So in other cases, you find that you are looking at a company that has numerous transfer related party transactions. And with numerous related party transactions, you may find that there are some transactions that may not be priced appropriately, or even if there is a transfer pricing policy in place, that the rules and regulations of that transfer pricing policy have not been enforced, and there's some transfer pricing, mispricing that has occurred. Then the second last one is transactions with a related party in a lowly taxed jurisdiction. And this is an indicator mainly that the revenue authorities will always tell us that whenever they see transactions between a company or a business here in Kenya and a business in certain lowly tax jurisdictions, then they do not, then already they're, it's a red flag for them, and they start questioning and they want to investigate more on transfer pricing with that particular company. Then lastly, it's interest-free debt financing. This one, I put it as the last one because as it's significant, yes, but again, there are normally good explanations for the interest-free debt financing. Normally, this is provided by a non-resident entity to a related entity in the country to ensure that there's capital for financing both its operations and also to acquisition of assets, its capital expenditure basically. And when a company is a startup, it may not have that ability to repay, hence the interest-free debt financing. However, from a transfer pricing perspective, the entity that has been advanced debt is okay. But the entity that is advancing the debt is not okay, because here it has given an asset to this particular related party transaction, related party, and it is not earning or being compensated at all. So it normally indicates that there might be a transfer pricing risk that is existing or underlying in that particular transaction. So I think with that, I've come to the end of my presentation, and I would want now to hand over to James or Moses to introduce Steve, and then we can move ahead with managing the transfer pricing audit. Thank you. I am Nzioka Mwindi, and I've been your presenter for that particular session. Thank you. Over to you, James. We can't hear you.
Oh, sorry, my microphone was on mute. Thank you so much, Nzioka, for your wonderful presentation. You've clearly addressed the transfer pricing risks as well as the indicators of these transfer pricing risks. We shall move straight to Steve's presentation. Steve, as I had earlier mentioned, is a tax director in Kenya, BDO in Kenya. He'll be presenting on managing transfer pricing audit risks. So Steve, over to you.
Okay, thanks a lot, James. I really appreciate. Thanks, Nzioka, for that presentation and for the points that you've already highlighted. I will be taking over from here, and we'll be covering a wide range of points that relate to managing this risk. So straight away, as you are aware, transfer pricing risks begin and end with the arm's length principle. That's very important to appreciate. If this is not appreciated, this is how risks arise, and then they have to be managed. So the management of transfer pricing risk can give someone significant amount of headache, and it comes at a major risk to the company. If not properly managed, it can have significant economic impact. My colleague Nzioka has already highlighted and mentioned how this really comes about. So the first thing that the company needs to really pay attention to is the issue of the arm's length principle. And my colleagues have spoken about it, and it has been stressed, but there has to be fidelity to the arm's length principle. If that is not the case, then the risk is going to arise. And we then find ourselves in a situation where, we have to come in and handle a KRA audit. And when we are handling the KRA audit, or it might result into a transfer pricing assessment. And that assessment can really give business quite a significant amount of headache. But for any large business, if you are an FC, if you are an MD of a company, transfer pricing audits are coming. Transfer pricing assessments may come. So this is just something to be prepared for. So preparation is the main issue to start with. There are certain mistakes that businesses make that also results into these audits. And I can mention them. They are not in the slide because they are quite simplistic, but I'll just cite them. The first step is you need to have a robust policy in place, and then you implement that transfer pricing policy consistently in your business. That's the first step. Because, and the reason why I say this is because trying to avoid transfer pricing audit may not be a viable strategy sometimes. For example, revenue authorities sometimes decide to target an entire industry. So they say, this year we are going after flour companies. We are going after vegetable companies, exporting companies that are operating in the market, that are exporting to Europe. In that case, if you are in such a business, there is no way you are going to avoid a transfer pricing audit. It's going to come because it's an industry-wide approach that they're just ensuring international tax compliance. So under such a circumstance, you can't escape it. Or they say we are going after mining this year, or we are going after manufacturing, but more specifically this particular subsector. Under such a situation, you can't avoid it. Sometimes a member of staff leaves the company and provides misleading or even accurate information about the business of the company. If somebody is fired in the finance department or in the commercial department, is fired and then he has to leave, and then out of vengeance or ill feeling decides to load information onto KRA or URA or TRA or any of these revenue authorities. Under such a circumstance, a TP audit is coming. Most of the TP audits actually still, even if you consider all issues, they arise from an in-depth audit. An in-depth audit is undertaken on a business, and then the team that undertake an in-depth tax audit invite the transfer pricing team. So under such a situation, it will be difficult to avoid it. So the key thing is to just ensure compliance, a consistent compliance, and to have a robust system. If you have a transfer pricing policy documentation, you know very well that you need to apply it. You also know very well that you need to review it approximately every 3 years to see if it is still valid, if it's still meeting the threshold of the scope of business and the circumstance in the market that you're now operating in. Every 3 years, that's a rule of the thumb. Or when the business significantly changes, then you have to review it. New lines of business, then you have to also review it. So these are common things that once you have them, or once you have them in place, then I can now take you through to the main issues. But you need to pay attention to them, or ensure you have a good document, ensure that you are adhering to it, and there are other risks that are going to come about, and you might have to face them. You can't completely avoid them. Many times, businesses ask me, Steve, how do I ensure KRA does not come to conduct a transfer pricing audit on me? There are many things you can do, but ultimately, sometimes you can't avoid it completely. So you really need to just have the preparation. Yes, so the BEPS process, which has now been codified into law. It's not just a question of a development which is coming. We've now gotten these things encoded into the guidelines, into the model tax convention, and in Kenya, we've also made changes to the Income Tax Act. And all these things are applicable. Country by country reporting is coming at the end of the year. So for large groups or players within the large group, this is going to really come into being. Interest expense restriction to 30% of EBITDA. This has now come in, or it's already in place. It's making it difficult for some sectors to operate, like the mining sectors and some agricultural sectors. It's an issue there. Limitation of benefits is also there. James.
Yes, Steve.
Can you go to the next slides? The next. How do I control this? Which one? Okay, so I'll go into the framework in East Africa, or the transfer pricing, the transfer pricing or legal framework in East Africa. And let me just go back here. As you know very well that the entire East Africa, we have a transfer pricing regime. So this is already applicable in all the East African countries. There is consistency of adoption of international standards, which is the OECD and all the developments within OECD. So these ones are already taking place, and these ones are well updated on everyone is quite aware of this. There is automatic or semi-automatic exchange of information that is taking place. So for Kenya, from this year, that particular exchange is now available and is going to be taking place. KRA will have access to the bank balances and bank information of Kenyans or Kenyan individuals or companies that have bank accounts and have financial assets outside the country. This is already there, and this is something that will provide KRA with additional information to be able to conduct either to select persons to subject to transfer pricing audit, or to actually get additional information that will enable them to conduct TP audits. James, you are taking control over your screen. It should be with me. Okay. Country by country reporting I've mentioned. For very large groups, this filing has to now be conducted within this year. So already the guidelines are already out. This is an additional requirement for very large companies that are operating in Kenya, or for companies that are part of a very large group. This is 95 billion shillings. You have to file that requirement at the end of the year. So this is an additional. This is
Steve, we can't. We've lost you.
Yes, I think you can hear me.
Yes, we can hear you now.
Because myself, I can hear everyone.
Okay, let me first mute and then you can take control of the screen again.
Okay. So there are, yeah, I have to take control of the screen. So there are requirements for country by country reporting. So the entities that are subject to this requirement should ensure that they comply within this year, because this kind of filings require significant approvals at the entire multinational organizations, different levels, including at head office. Then the discussion and the process of this work needs to be undertaken earlier on and in good time. And in good time. So that's the issue with country by country reporting, or the requirement for this year. Effective 1st of July, effective 1st of July 2022, we had local file and master file filing requirements. So these ones we just have to ensure that we maintain these files in place, and there is no issue of them only being prepared when now KRA knocks at the door and is asking for compliance.
Steve, we've lost you again. Steve, are you there?
I'm here. Can you hear me?
Yes, we can hear you now.
I can hear you very well, but it seems, can you move to the next slide?
Steve, can you see the next slide?
And the next. Yes, I can see the next slide, but I want you to go to the next development, which is the extended definition for permanent establishment. Okay, so in terms of PE, in terms of permanent establishments, so in this era, our experience with permanent establishments is that most of the PEs will be PEs of foreign companies, mostly companies coming from Europe or the United States or the Middle East. So Middle East and Asia is a bigger, many of the permanent establishments, these are branches of foreign companies. We are having companies that are coming from those particular countries and are having permanent establishments. They are having branches here in East Africa. And so an issue that arises is, how do you attribute income to that particular branch, to that particular permanent establishments? Branches of foreign companies are called permanent establishments. And the guideline is very clear as to how this is to be undertaken. But while I say it's very clear, it's not a very easy aspect of international tax. It's not a very easy aspect of international law, and it's subject to a lot of disputes, and many people have had disputes going to the tribunal or going through audits or objection review. So the different types of PEs are general PEs, construction PE, site PEs. Most of them are actually construction permanent establishments. Then the service PEs are also there. Local branches of companies that are providing services to their head office. Then we have exploration. This is very few of them are exploration PEs, and this is dependent agencies that are set up locally here. So in terms of permanent establishment, the first step to note is that a permanent establishment is actually defined in law. What a permanent establishment is defined in law. It's if you have presence, local presence, or which is undertaking certain activities, and those activities have the potential of concluding contracts or playing a major role in concluding commercial contracts, and they are undertaking a major aspect of the business of the head office, then that kind of an entity, a local entity, a branch, is likely to create a taxable PE. There are certain PEs that are not taxable. So if it is just, you're just having a bank account for your head office to just receive money and then you transfer it. So that bank account does not create a taxable PE. Or you are having a liaison office to just, undertake some very little activities locally, or to just have your ears on the ground. Those ones may not attract tax, but the law is clear that where that threshold, undertaking major aspect of the work, concluding contracts, or playing a major role in the conclusion of contracts, then you will find yourself in the position where you are in the PE. And the Income Tax Act of Kenya has expanded the scope of definition of different types of permanent establishments, but the concept is the same. The concept is the same, and that remains standard across all the different types of permanent establishments. James.
Steve, are you there?
I'm here, but I need you to move. I need you to move the slides to the issue of residency of a foreign company. So there are certain, this is a critical development of a complex area of international tax. There are circumstances where a foreign entity may be deemed to be subject to a control or management which is based locally. So it's a completely non-resident entity, but you're finding that all the directors are here, major decisions are undertaken here, board meetings and minutes are actually undertaken here, or it's basically for all intents and purposes being controlled locally from Nairobi, for example. Under such a circumstance, such a non-resident multinational may be deemed to be subject to local tax on its business income, actually global business income. Because if you look at Section 4 of the Income Tax Act, a resident entity or an entity which is deemed to be resident based on management and control will be subject to tax fully in Kenya. So that is something that a risk that has to be managed for people who are managing such or entities, MDs, directors, or shareholders, or even people in finance. Then the next slide on economic substance requirement. This is also something to pay attention to, or for those who are managing international compliance, international tax compliance for the businesses that they run. This risk normally occurs in a situation where you are paying for services to an entity which is registered maybe abroad, maybe United Arab Emirates, in Dubai, or in India, or in Mauritius. But when that entity is actually reviewed or investigated, it is found that there is actually nobody in that particular company. They don't have physical office. They don't have any staff. There is nobody who is undertaking transactions there. Actually, secretly, if it is reviewed, the people who are actually doing the deals and earning that commission or earning that service fee are actually just directors who are based here. It's just a conduit for transferring money. So such an entity needs to demonstrate substance. International tax does not stop any kind of transaction, provided you can show that the service is being provided. It can be provided by that entity abroad, or that entity can actually outsource that kind of activity to another business which is located elsewhere. So now I'll move to the next issue, which is TP documentation. And I'll go straight to the point. On TP, my colleagues have indicated, or the people who are subject to TP requirements and TP documentation. Go to the next slide, please. And the TP documentation process involves fact-finding and very detailed technical analysis. This is what we love doing here at BDO, doing thorough TP analysis and coming up with the correct methods for transfer pricing for those transactions. There is an entire process of analyzing it. It's both qualitative and also quantitative. We use two databases for undertaking our economic analysis and undertaking benchmarking. So we go thorough and we review this. Now, there are some people who already have TP policy documents which may not be thorough or may need to be updated. The easier thing to do if you want to be sure that your document is compliant, you can have an opinion. You can have it reviewed and a written opinion be issued to you as to how the treatment of those transactions, whether it's compliant or it needs to be updated. So that is the only thing that someone can do, but this is generally the process that we go through. It's very thorough. It involves a lot of databases. Information is collected and then analyzed with the aid of tools. Move to the next. Next. Oh, the previous slide. Okay, so these are the transfer pricing methods everyone knows. Comparable and controlled price method. This is always the preferred method when it is applicable. It is the preferred method when it is applicable. The main word there is when it is applicable. So there are very few circumstances that it is applicable, but when it is applicable, or Chapter 2 of the OECD guidelines states clearly that it needs to be considered and applied. This is comparing like for like. You're buying the same type of goods from your related party, and under the same circumstances and quantities in a particular year. It's the same transaction. The pricing of those goods or services should be the same, should be comparable. That's comparable and control price. It is the first price, it is the first method to be considered before any other method is reviewed. Cost plus method, mostly applicable for services. A markup which is arm's length, which is consistent with market prices, with market price, is applied onto the cost base, the total cost base. Then the resale price method for goods which are then sold in the market or on a resale basis. So the resale margin is considered, and if that resale margin is consistent with the arm's length principle and it's benchmarked, then it's adopted. TNMM is the one which people apply the most. Transactional net margin method, where the net margin of a business is considered, and if it's consistent with the arm's length scenario, then it's passed as compliant. Profit split method is applicable on very few circumstances, mostly where two entities within the same group are contributing value to a transaction. So, can you move to slide 55?
Okot, at this point, they are not numbered. Perhaps you could mention the title of the slide.
Yeah, that one. That one is where you are is the correct one. Go to the next slide.
Steve, are you there?
Okay. So management of transfer. Yes, I'm here. So management of transfer pricing risks and TP audit process. I think we've spoken extensively about the transfer pricing risks and how to manage them. Starting straight away with having the correct compliant documentation, which is thoroughly aligned. So that's TP, or you have to undertake the strategy, then TP documentation. Then after that, it needs to be implemented and monitored. Monitoring can take place either internally or with the support of a professional who reviews or the document or reviews how the transactions are being undertaken. Then of course, when the TP audit comes, then that's where really the interesting bit then comes into play. Now we will advise on as to how to really undertake, how to manage a transfer pricing audit or process. You can manage part of it yourself, but the professional view is that such a risky audit, a risky tax audit, you need the support of a seasoned professional on the ground to ensure that documentation is correct, the correct information is given, the correct responses go through, the management of the relationship is proper, and that when the findings come out, they are responded to appropriately. There's a lot of nuances that have to be gone through, and the advice there is that it needs to be managed properly. Can you move to the next, to slide 58?
What's the title of the slide? Because the numbers are not on the slide.
James?
Yes?
James?
Yes? Steve, can you hear me?
It's managing TP audits. Or the previous slide. Yes, I can hear you. Go to the previous slide. The previous slide. Oh, James, can you hear me?
Yes, I can hear you.
Yes, so this is the slide. You are going very slowly with us with the response on the slides.
Oh, I think it's there.
I've already mentioned the key issues. Go to the previous slide. Yes, I mentioned the key issues or relating to how to manage what it entails. It's about records. It's about information and responses and engaging the revenue authorities. The entire process of handling or transfer pricing or issues, especially disputes, is there is request for information, there's a field review, the findings are presented, assessment is issued, objection is issued. There's objection review process, which is a detailed one. You can have a very detailed process there at the objection review. If it doesn't succeed, you can go to the tax appeals tribunal. At the tax appeals tribunal, there is also the option of resolving the matter through ADR and presenting an agreement. If it doesn't go through, then it goes to the court. That's the process. Go to the next slide. Yes, so there's the issue of risk relating to services. When it comes to services, there are certain things that have to be looked at. You don't just charge intercompany, you don't just charge for intercompany services just like that. It can cause serious problems if it is not well supported. The first thing is to check if that service is actually provided. So this is checking and then supporting that it is actually provided. Now, if it is found that a service has not been rendered, then there is no need for even transfer pricing. The cost will be disallowed. So the provision of service needs to be supported. Then secondly, did that service really provide value? If it's just a vestigial service which did not provide any value, then it's also not allowed. Then is it duplicated? Is it being done from the service center abroad and then also being undertaken internally? You have an internal audit process and then head office also comes and undertakes another internal audit. Duplication is not allowed. Then shareholder activities or services that only satisfy the assurance of shareholders is also not allowed. So those are the risks that have to be managed when services are being reviewed. Then in terms of sale of tangible goods, in terms of the supply of goods, this one is never a difficult process because there is always support for the goods. The pricing of the goods is an issue that is subject to transfer pricing review, and is always something that we have to look into when we are managing TP disputes. Then, in terms of intercompany or transactions involving intangible assets, trademarks, rights of use, patents, know-hows, business formulas, these ones have to be benchmarked. There are tools that we use when benchmarking this, but you can't just pluck a figure from the air. You can't just go to Google and ask, what do we normally charge for this kind of in this industry? It's a restaurant. What is the franchise fees? I want to also charge my people franchise fees. It has to be benchmarked and there are tools that are used. You can't just pluck a figure from there. Can you go to the next slides? The next.
Steve, are you there?
So this is, we've selected some of the TP dispute cases that have been decided by courts. Yes, I'm here. Can you hear me?
Yes, I can hear you now.
My
Steve, we can hear you, but there seems to be a gap between when you say something and when it reaches us. I don't know if it could be a connectivity issue or something.
Okay, yes. So I have the first case on Bear Cement vis-a-vis the Commissioner General and Tanzania Revenue Authority. So it was a case in 2017, and the background of it was that
you can. The video. Can you hear me? Oh, you can hear me very well, isn't it? Can't you?
Steve, are you there?
Yes, I'm here. Can you hear me?
Yes, we can hear you now.
Go ahead.
okay, so this is Magdalene. I'm presenting the cases, and specifically the three cases are on certain aspects in transfer pricing. So we have the first case on duplication test, and duplication of services occurs when the services provided by the related party to a related entity is the same services as services provided locally for the other entity, or they are outsourced. That is according to the OECD guidelines. So we have this case for Bear Cement vis-a-vis the Commission General Tanzania Revenue Authority, and whereby we have the Bear Cement, they had paid a franchise fee to its related entity, but now some of the fee paid also paid some of the fee to the third parties. So in relation to the same services, but according to the court ruling, they had to disallow this because the same services provided to the related party were also outsourced. So we have to be careful in relation to what services are provided locally in relation to what services are provided to the related parties. So in terms of transfer pricing documentation, and especially when we are doing the functional analysis, we need to be clear while documenting the functions performed by the local staff, especially for management support services, so that we do not duplicate the services that are provided locally or from third parties. So that is the relevance of the case. I would move to the other case, and This one is the requirement for the proof burden, the burden of proof, the taxpayer's burden of proof, and the issues relating to these it's because the costs that were claimed by the Dubai app were not verified by the independent auditor, and also the turnover of the group entities was how it was determined was also not transparent, and also again the costs which benefited the group entities were not clearly identified respectively to the benefiting entities. So these costs were disallowed on the basis of the Agreco's failure to submit documentary proof of services rendered to the corresponding or to the actual costs that were incurred. So the court ruled out that in absence of sufficient proof that then these costs are to be disallowed, which is a big loss. So it goes to the taxpayers, our clients, and everyone, and we are supposed to insist on that the burden of proof lies on the taxpayer. So partly as we document, we do not just put the content of the documentation policy, but we need to be relevant enough. I would go further in terms of, especially for recharge of costs, also provision of support services or provision of services. We need to provide sufficient documentation to prove that the functions were actually provided, and we can justify that before the revenue authorities. So we need to be vigilant on that. How would you go to the next case? This one was on Nisli, Zambia, and the Zambian Revenue Authority. And sometimes it's questionable what happens when a company continuously declares losses continuously. And the issue here was we need to clarify what functions are performed by a local entity and what functions are performed by the parent or the constituted entities. So in this case, we have the Nestle Zambia Oil Trading Company in Zambia, which declares losses. But now the issue here was, should this Zambian entity be should it be remunerated a higher margin, or should it be remunerated on a constant operating margin based on the risk assumed? So based on, I would reference this back to the functional analysis. Based on the functions that are performed by the local entity and the parent or another related entity, then we need to see who has assumed higher risk, and so that we can match with the compensation. So in this case, the ruling was that it was ruled in favor of the Zambian, the tax authority on the issue of reclassifying the Zambian entity as a limited risk distributor, who is supposed to be compensated on a constant margin compared to the Nestle Zambia, to the main entity. So we need to be careful as when we declare the losses or continuously, that we should be able to clarify the risk assumed by each entity, and so that we can determine the accurate compensation for each entity. So in summary, those are the three cases in relation to transfer pricing and documentation in relation to functional analysis.
So now I think we've come to an end of the webinar. If I'm to give the take home from this webinar in terms of management of risk and also the developments that have taken place and are taking place in the transfer pricing arena and in the international tax arena, we expect So the developments globally have already been codified into Kenyan law. We expect the same treatment to take place in the region, in Uganda, in Tanzania, in Ethiopia, or they are going to adopt these developments that have already taken place. So what we can support our clients with is to review the TP documentation which is in place. Our teams can also undertake a health check after review. So you can conduct a review of the document and say this document is still okay and is proper. A simple 2-page opinion. You can go ahead and have a health check, a limited health check, or you can have comprehensive covering all taxes that has the compliance been consistent with this proper document. Or if the document is not proper, then it's reviewed and overhauled. And that additional documentation, you monitor what is the risk that you've already undertaken. Then you take a decision how that risk is to be managed. So this is how we can assist those who are having new filing requirements. They need to put in place the mechanism for filing in good time. Otherwise, I have seen a lot of Q&A. I now hand it back to James to continue moderating the next process.
Thank you so much, Steve, for that presentation. And thank you, Magdalene, as well, for the presentation on the cases. It was quite elaborate. Yes, as Steve has mentioned, there are a number of questions in the Q&A. Unfortunately, some of the panelists weren't able to see them. I think it was probably due to some technical challenges, but I'll go ahead to read them. Steve, I'll kindly request that you assist in answering them as I read them out. Yes, so I'll try to assist with the Ugandan questions, and then I'll go ahead and ask Steve where the others are coming. So the first one in relation to Uganda was asking, it was Huntington asking whether the practice,
to begin, we will share the slides. Those who are asking, so we will just before you continue. Before you continue, I'd like to say that we will share the slides to everyone who has attended the webinar. So now proceed.
Okay, so the first question is from Huntington. He's asking,
James.
in line with the... Yes, Steve?
Just continue.
Okay. So Huntington is asking, in line with the practice note of 2012, what are the exact documents that are needed in the local TP file? So Huntington, the practice note of 2012 is largely about the contents of the transfer pricing documentation, as opposed to listing down documents needed. And in terms of content, they're looking at an industry analysis, a function analysis, a comparability analysis, and the sort. So it's all about what you put into the documentation as opposed to a list of those documents. Then anonymous attendee was asking, how does Uganda define an MNE? If there are two Ugandan entities that are part of an MNE group transacting among themselves and with non-residents, based on the definition of an ME, will they still be captured under the threshold? I think there are like two questions in one here. So the first one is in relation to an MNE. And yes, because with MNEs, we are looking at, under the regulations, we are looking at a company and the practice note as well. We are looking at enterprises that manage their production and revenues on a cross-border basis. So it's all about their status as opposed to one particular transaction. And then in relation to the threshold is not just about you. It doesn't relate to MNEs. MNEs in Uganda are required to comply with the transfer pricing documentation in the practice note. It's just that other entities that are not MNEs are the ones that need to come under the threshold that Juma mentioned earlier on in his presentation. So you being an MNE doesn't cut into the threshold requirement. Then the last one, so the others, I can see Steve is typing the answers to those ones. So you'll be receiving your answers there. Otherwise, thank you so much for coming in here. It has been a wonderful presentation. We really appreciate. We apologize for the network connectivity issues that happened earlier on in the during the presentation, but we very much appreciate your presence and look forward to engaging you even beyond this presentation. Steve, do you have any closing remarks?
Oh, thanks a lot to our clients who have attended this webinar, or taking your time so that we can share our information on risks and developments and management of the same going forward. We remain available to answer any questions or that are there. We'll answer all questions and then update into the last slide. We will put the key content questions we will put into one slide, and then we circulate so that everyone can see the key questions that were asked and how we've responded to them. Otherwise, thank you very much and have a good evening.
Thank you so much, Steve. Good evening, everyone.